Is the glass half full or is the glass half empty? Let's ask Patrick Armstrong, CIO of Plurimi Wealth. Risk on, risk off?
I think we're going to be in a bit of a middling phase right now where there's enough earnings growth that should keep risk on, but there's enough question marks around geopolitics, trade, and...
So what am I long of and what am I short of in that scenario?
Well, what I like is the sectors that people are most fearful of. So if you're not going to have a big event, you want to go long where people are worried about. So I think cyclical risk in Europe, still good value. I don't think Europe's falling off a cliff. I think there's still some growth. Leading indicators are slowing a little bit, but it's still consistent with 2.2% growth, which is more than enough to generate solid earnings growth for the industrials and consumer stocks in Europe.
So is the idea, Patrick, that if we do have a trade war, we'll be able to figure it out with enough time to sell the assets that we need to? I mean, it doesn't look good, right? But it's kind of a slow-moving train.
Yeah, we've almost been here a month ago where things were starting to look bad. The rhetoric was increasing, and then market sold off, and the Trump administration sort of pulled back and said these things are on hold. And you're almost getting a bit of an implicit put option right now with the White House administration. If they do anything a little bit too chaotic, market responds, and then you see some backtracking. So our base case is there isn't going to be trade wars. There may be some tariffs. They're not going to be overly material for the economy. And I think there's enough sensible people in the world that if the U.S. continues to increase trade tensions, Europe and China and other countries can agree. We can do tit for tat on Europe, but on U.S., but continue our trading relationship. So you may even have a net beneficiary for countries that don't participate in trade wars with countries that may engage them.
Euro dollar, it's come back a little bit over the last kind of few days, but nevertheless, it's still significantly different to where we were a year ago. So you're a kind of industrial player. I'm curious as to how much of that is based on the fact that there was a real headwind. Yeah. That headwind is now abating, and you could see it in the Q1 numbers. How big an impact is that going to have into those cyclicals?
It matters a lot, but you also get an offsetting benefits. When the economy is strong, the industrials do well, but the euro goes up. So it's almost a natural hedge that if things start to go south for the economy, the euro is going to weaken, and you'll get the foreign revenue.
And the euro has weakened, though.
It has weakened significantly over the last couple of months, and that's a tailwind for the industrials right now. They performed very well in March. They weakened a little bit around Italy, and I think it's a good buying point right now.
Do you expect anything? Do you expect the ECB to just be happy with that and move on business as planned, ending quantitative easing in September? Or do you expect the flare-ups that we see, the likes of Italy, for example, to change that at all?
I expect September is the end for QE, but if there is a significant flare-up, that will be changeable. I don't think we've had enough risk right now that Italian bond yields got above 3% on 10 years. They're back down to 2.5 or so. It's not a crisis right now. I think as long as you are seeing some growth, a little bit of prospects for inflation in the northern economies, the ECB probably justifiably will be ending QE, but you still got negative interest rates, and they're not contracting the balance sheet the way the U.S. is, so it's still very accommodative policy.